Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the volatility index, ticker symbol VIX. As I usually do, I've left my lines on the chart from the previous week's report so you can see how this analysis works out. And right here, as I zoom in, you'll see that I put out a 2-week forecast on the VIX. The week before last, I drew this line just in an exact angle, just like that. And it was more or less mirroring the angles that we saw in past rallies. And I said that the VIX would most likely hit that target, which was 25 on that scale right there. And you can see today, the VIX hit a high of 25.14. So that target is hit. But what does that mean for next week? We have to look at this because we got a lot going on this week in the markets overall. If you look at this particular candle right here, this is known as a shooting star. It's like an inverted hammer, except it's at the end of an upward leg here. And with that, when you see these long shadows, it means that the stock is getting some pressure on the sell side. And the volatility index is traded by many option traders, and you can go directional with it. But when you see a long shadow above that candle, it generally means that we're getting ready to sell off a little bit. If I go back in the past, you'll see here is a long shadow. Here is a long shadow. And you see back here, long shadows above the candle right here as well. And what happened? Prices dropped. Now, I'm not expecting this to drop in a big way. However, I do think that the VIX could come right back down to test this support level. So I'm expecting the VIX to do a little bit of this, and I'm going to do another 2-week forecast because we have shortened trading weeks coming up for Christmas and New Year's. And so this could really put a different type of a spin on the analysis because the volume most likely that's being reported will be affected. But once the VIX pulls back, I think we could see that. And so if you are hedging your positions, understand for the most part that the VIX is inversely related. Not always, but many times it's inversely related. So if we're expecting the VIX to pull back Monday and Tuesday, we could see a little bit of a pop in the general markets. But then when the VIX starts to rally, you got to watch out below. So this is a good risk management tool. Another thing that you want to keep an eye on is the CCI down here. Because if the CCI starts turning, and I think it will, again, that will most likely lead the price lower. But then once the CCI starts moving back up, it's going to give us some early signals as to what that pivot point might look like. All right, so that's the VIX. Now, if you look at the SPY, which is the S&P 500 ETF, left my lines on this chart as well, and I did something different, very different than what I usually do. I didn't put short-term price targets out. What I did is I identified the most recent support levels. Okay, now the support levels are being used now to gauge our risk points, especially for those who are long the market right now. And I said last week that this is a support level from the bottom of that hammer. And I said, if you are trading anything in the S&P and you're long, you want to be putting your stop somewhere below that support level. Hence the reason why I have that little hash mark there. Now down below, we still have some open gaps. So again, while I think the S&P could go up just a little bit, I do think the reverse will happen where we could pull back and test that support. Now, if you are long any of the S&P stocks or if you're long any Dow stocks and the market does not pull back, then you have not lost a single thing. Why? Because you are putting your stop below the support level. So in other words, if the price goes higher and you have your stop down here, then guess what? You now have an opportunity to move your stop up to the next support level. And so that's what the S&P looks like right now under the SPY. Now, if we look at the diamonds, I'm going to switch right to that. Same thing. What did I do? I'm identifying the support levels. Here's the support level, very similar hammer pattern. We have our stop area right in this area right here, right at that price. That's right around the 294 level right there. And we have gaps below the market again. Now, for the diamonds, I tell people all the time, if you're long and you could almost feel that the market is getting a little tired, and we're not racing to set new highs. We are at highs, but we're not racing and storming up to the highs. Why? Because there's a lot of people that are focused on this monthly chart that is showing this megaphone pattern here. This is a megaphone top, broadening top. And so if you are long anything, you really should be protecting, based on this pattern here, protecting against your downside. And what that means is if you get stopped out, move to cash and maybe reverse your position to the downside. Nothing wrong with that. In fact, we make more money on the way down faster than on the way up because fear is the factor there. It's a fear factor. People tend to fear, and that fear pushes prices down much more quickly than prices rally. And we saw that January, February, March in that pandemic. People feared that, oh, the world's coming to an end. The U.S. economy is going to come crashing. So again, keep an eye on the monthly charts. Gauge your risk according to the support levels, and I think you'll do just fine. Now, if I look at the Russell 2000, this one did the best out of all of them. But look, we now have this megaphone pattern forming. See this? And we have not pulled back from this yet. So while the Russell 2000 did the best job with maintaining the prices higher, this one actually becomes the biggest risk point for us, because if you now go into the daily chart, you'll see that we're right at that megaphone top here. And notice down below as I zoom in, I'll erase this, but I'll continue to draw this. We are seeing lower highs on the CCI after we continue to see higher highs on price. That's known as a negative divergence. Now again, we just got finished setting higher highs in the IWM, but notice down here as I magnify that, that's a sell signal. See that? So again, I'm not telling you get out right now, but what you might want to do now that I've drawn this support level is move this up, because now we have what's called a roll reversal support level right here. So the former resistance here, broken here, turns into new support here. So if you are long stocks in the small cap area here, you're going to take the stop and move it up to just under that 20-period moving average and just under that support level. It's really as simple as that. It's called trailing the stop. You're more or less stepping up and protecting your profits along the way, because if you get stopped out, you're stopped out at a profit. And now what you've done is you've created a situation where you now have more buying power to participate after the markets have sold off, and now they're looking to find new bottoms. You see, so this is the beauty about having a strategy in trading, is that you can absolutely have those points where you can create some cash for yourself. All right, now this is really interesting because the Qs almost closed with a weekly bearish engulfing pattern today. At one point, we were down below 300, and it was almost midday, and this thing was completely red. And I'm thinking, oh boy, this is going to be a rough week next week. But guess what? On the close, we bounced back, and we did not complete that bearish engulfing pattern on the weekly. But with that said, notice we have a higher high from last week and a higher low. See that? That is what defines an upward trend. But look down below. CCI is going down. So what I'm going to do is I'm going to maintain this support level right here at 294.39 and recommend that you keep your stop somewhere below that level right there. Okay, so that's the Qs. So I'd like to ask you a favor. If you could, go to the YouTube channel that you're watching right now, click on the subscribe button. Please do that. You're helping everyone, not just me, not just you. You're helping everyone get this information. And please like it. Like it, because the more likes we get, the more it gets pushed up into the menu through the algorithm that YouTube uses, and more people will be exposed, and you're helping those people with managing risk. And finally, if you look down to the bottom, you'll see a button there that looks like the shape of a bell. If you click on that, you'll get notifications as to when I put the trade alert out, and you'll be able to get it. So that's it for now. Have a great weekend, and we will talk to you next week. So long.